I do want to start first, though, with the idea that there's a correlation between how the S&P 500 is trading and oil prices, and that it's just been phenomenal, this correlation over the last while. Does that continue?
Right. So when you look at what's happening in other markets, call it the dollar, call it the S&P, so equities, call it oil markets, we have seen significant correlation over the last little while. But we really believe that the oil market, because of this fundamental framework that's changed quite drastically over the past number of months, we do think that over the course of the balances of the year, oil prices will likely march to the beat of its own drum. So from that perspective, we do believe that the backdrop for the oil market is actually looking quite constructive. When you look at global oil demand, it looks very strong. OPEC's compliance levels remain very high. We're running down inventories at a very rapid pace on a global basis. And then, of course, we are seeing some supply disruptions on a global basis as well.
Does that give the rise to the threat of a supply gap?
I think it does, in the sense that when you think about the gap that we've all been anticipating over the course of the next several years, there's this idea that we like to talk about that we call phantom liquidity. So in the sense that you have a lot of liquidity that's in the front end of the curve. When you look out to the term structure, so the forward curve, what you have is a lot of this liquidity is dried up. So while you still see prices out the long-term portion of the curve, it's anchored at a very low price. So WTI prices for calendar 2020 time period is pricing at about $52 a barrel. The issue here is that there's not that many countries on a global basis or companies on a global basis that can make final investment decisions for projects that are long lead time, slightly more expensive in a $52 price environment. So we do believe that there are real tangible decisions being made in boardrooms with management teams for producers on a global basis that will ultimately likely continue to be halted over the coming years. So we are in this perpetual state of underinvestment that will ultimately lead to a supply gap in the coming years.
But there's lots of oil coming online, though, from various countries too, right, Michael?
Right. I think most notably right here in the U.S. I think the key thing here is when you look at the U.S. and you look at how U.S. shale is completely disrupting the global oil market, we've seen that over the past several years with shale ramp up. The second thing here is not just the shale production story. The U.S. is certainly not just a one-trick pony in this oil market, but what we've seen is a second leg of the shale revolution. So what you've seen is U.S. exports have completely rewritten how we think about global trade and competition and market share. So for example, when you look at the U.S. and China, what we've seen is 2 years ago, 3 years ago, the U.S. would export 0 barrels to China. Why? Because we had a U.S. crude export ban. What we've seen now is the U.S. is exporting on a daily basis 300, 350, 400,000 barrels a day to China every single day. So from that perspective, we think that the U.S. is really the Walmart of the global oil market. Anything you want, we have it right here in the U.S.